Welcome to TheoTrade. This is Don Kaufman. Here we are. It is Monday, May 2nd, 2016, and we're taking a look at the markets with just about 5 minutes to go to the close. The S&Ps right now up 16, but don't get too excited just yet. Well, we had some European markets that were closed today. All right, some of the Asian markets were closed today. So ultimately, what we're getting right now is what I would term a very low liquidity day. And often I'll tell you, don't trust anything you see in these really low liquidity days. And what does that really kind of amount to? You want to kind of quantify things, but if you take a look at the S&P futures, and I'll just zoom in over here. And again, you may never trade S&P futures, but it's a great kind of watermark for the rest of the marketplace. But if you look at the S&P futures, they're barely doing over 1 million contracts today, which just take a glance back over here. This is pretty much one of the lowest volume days that we've seen. And yeah, we've had one here and there scattered throughout, but you got to go back to a few days after Easter to see this kind of really low liquidity day. So apparently Europe and Asia markets being closed are having quite a drastic impact on there. Nevertheless, the S&Ps are still up 15. So a move is a move, right? But you got to remember, in a low liquidity day, there's not a lot of, heavy movement behind some of the action the market's taking over there, which means things could be undone rather quickly. Now, there's some areas that, again, are a little bit more convincing. Number one, the volatility futures are down a full point. The VIX is also down a full point. But one of the things that is on the move today and continues to be on the move is the bonds. The bonds are all the way back down to the 162 handle. And again, you may not, use the bond product over here. Volume is also very, very light in the bonds. But the point that I want to make inside of the bond market is we're seeing increased ranges on a day-to-day basis, even in the midst of this move from 167 all the way down to basically 161. We're seeing, again, days where the bonds are typically moving like 1 point. If you look in the last few trading sessions over here, bonds, they're moving. I mean, we're getting like 1.5, almost 2 points of movement a day inside of the last few trading sessions in the bond product, to be watched very, very carefully, because on a dime, the bonds can rally or sell off over here. And they've been doing that on an intraday basis, the rally, the sell-off, and it's been wreaking havoc inside of the financials. The bonds down, though, the financials up. Okay, the bonds having rallied could actually put a little bit of a hurt on the financials over there, take down the rest of the market. But in this low kind of volume day, there's something that's going on that's a little bit more than maybe meets the eye. And for that, I'm going to go over to the sectors. And again, across the board, you've got all 10 sectors up. So what do I see in here that stands out? The energy sector. And the energy sector happens to be, for the most part, a flat line in today's market. And if you're not comfortable looking at, different sectors or familiar with the energy sector, one of the other ways you could do this is to look specifically at the XLE. And the XLE is the ETF for the energy sector. And the reason I point that out in today's trade is, again, this has been the strongest sector in the last few weeks. All right. The energy sector has been explosive to the upside. The last few days continues to kind of fade, even in a day where the S&Ps are up some 16, 17 points. Energy cannot get out of its own way. I have already established a short position inside of energy. I will maintain my short position. I am short shares of the XLE. Additionally, okay, I've got an 18-day spread left here in the 20th of May expiration. So again, I'll sit with my short positions inside of energy. We'll let it play out. Now, that's not all. Okay, again, today the S&Ps are up 16, pretty much undoing what we saw last Friday. Last Friday, the S&Ps were down about 1250 at the close. So, this rally back up is just undoing that. For the most part, though, there's another area that I don't think a lot of people look at, and that has to do with correlations. And one thing that I noticed today is often when you get a market rally, Okay, everything kind of moves in lockstep with that. And when you see the S&Ps, they're up 15 or the S&Ps are up 20, more often than not, okay, you get 90, even like 93 stocks to the upside. And what I've noticed here is, again, the correlations are kind of breaking down in the market. That's actually not a very bullish sign for the market, is that, again, yes, the market is rallying today, but apparently not every underlying agrees with that. And that's inside of the S&P 100. And there, of course, is the closing bell. But I also noticed this inside the NASDAQ 100. And again, NASDAQ 100, it's up, 0.9% over here, but still only has 80 advancers. And some of the largest market caps, okay, again, unable to get out of their own way. Specifically, of course, you're going to relate to Apple here, which is stuck at 93. Google is moving in line with the markets. Amazon still exploding after the earnings announcement. Again, though, there's a number of NASDAQ stocks that are not moving in accordance with the NASDAQ itself, which is, again, it's unusual to see this in the midst of what appears to be a larger, again, low kind of volume rally over here. The next few days, where does this really leave us? The next few days of the market, again, are, I believe, critical for the future of this entire month over here, as we're kind of dangling in the S&P right now at this 2080 kind of mark. And again, to look at this on a little bit of a broader take over here, sure, we saw some sell side activity last week, got us maybe a little bit nervous. We bounced right back up. But here again, we have been in an extremely tight range of back into this 2040 kind of 2080 range. That's a 40-point range, and you can take this as far back, all right, is well over a month ago. So 6 weeks, we sit in this extremely tight range over here. Now, again, the S&Ps themselves, they don't look like they're denoting any risk at all. With 4 days remaining to expiration, if you take a look over to the right-hand side of the screen, the S&Ps are only expecting a $24 move. That is, again, an inordinately small move being priced into the next 4 days of trade. Just keep that in mind, because what it really denotes to me is, again, I don't really want to be a seller of premium when volatility is that low. For the most part, you look at volatility that low, and that's option premium. Can't really go much lower. So for the most part, it can only really go higher. And there are signs of risk emerging. Now, again, nothing extreme. Volatility hasn't really come up. Nevertheless, the markets are not moving, okay, in a normal correlation. As I said, as the market's moving up, usually you get like 90 advancers in the S&P 100. Here we got, 80 and change. The same thing in the NASDAQ. The NASDAQ moves up 1%. Normally you get, at least 85% correlation. And we're nowhere near that. And that's some of the key points to be made over here. Some of those key correlations are breaking down. I believe in the next few days, you watch the bond trade very carefully, as it is going to be what dictates the next move out of the S&P 500. Thanks a lot, everybody, for joining us here at TheoTrade. I'm Don Kaufman. Be back in our chat room and with coaching sessions all throughout the course of this week. Have a great evening. Bye-bye.